Thank you, Dave. And hi, Abby. Thanks so much for joining us today. Just a reminder for those of you watching live, we'll be taking audience questions at the end and maybe a little bit throughout. So please feel free to enter them in the chat at the right of your video player. Fidelity and CEO Abby Johnson don't need much of an introduction. The financial services firm has been a trusted household name for almost 75 years, and Abby is well known for her thoughtful leadership of the financial services powerhouse, which now has 76 million customers, 8.8 trillion in assets under administration, including the 3.5 trillion it manages directly. Abby joined Fidelity in 1988 and has been at the helm since 2014. We have a lot to cover, so let's get right to it. Abby, it's great to speak with you again. Thanks so much for being here.
Well, thanks, Beverly. It's great to be here, and it's great to see you, almost be with you, feel like I'm with you.
Hopefully in person again, not too distant future. So one thing I knew I wanted to talk to you about is the issue of disruption, because I know it's something you think a lot about. Fidelity has weathered and in many cases been the force behind a tremendous amount of disruption in the financial services industry. So let's just start kind of broadly. Like, how do you manage disruption? How do you spot what's ripe for disruption?
Yeah. So there's clearly a lot of disruption that's been going on across our industry, and a lot of it's driven by technology and people's sense of value. And so our aim is to increase our pace of innovation in our organization across the board. We look at innovating new products, new services, and innovating the way we do the things that we do already. At the core of our business we are at our heart a service business. And so we need to be looking at doing what people count on us to do every day better. And so it begins with constant improvement for the key parts of our business that people depend on us for on a day-to-day basis. Now, if you look at the economics of our industry, and Beverly, you've done lots of this, I know, the key economics of our industry have been changing for well over a decade now, really close to 2 decades, where pretty much across the board there is fee compression on pretty much every offering that one can think of for consumer financial services. So what that means is that people expect to pay less for everything in our industry every year. At the same time, people's concept of service has been changing, and it's evolving and increasing, and people peg their standards to what they expect in terms of service to what they experience in all kinds of their lives as consumers, not just financial services. So that means a higher level of service. People expect us to do more for them every year, and they expect us to be able to figure out how to do it for less money. So that's really what's at the core of disruption in our industry. So striving to keep pace with that is what is job number one for us every day. I mean, at the same time, I know you've also covered this extensively too, Beverly, is just the rate of change. And a lot of that is driven by innovation in our capital markets. And to the extent that there are new opportunities that become possibilities because our capital markets are operating differently or offering new things, then that's an opportunity for us to create new value for consumers.
So you alluded to this, and I want to dig in a little more. Like many businesses, many of Fidelity's products and services are becoming commoditized. Annual fees on ETFs and mutual funds are cheaper than they've ever been by a lot. If you really look back historically, Fidelity is among the many online brokers offering free trades. How do you stay profitable when so much of what you offer is getting cheaper and more widely available?
Yeah, a lot of it has to do with scale. And I think that's one of the reasons that you're seeing so much consolidation in our business, is that in our business, technology is our friend. That's assuming that we use technology effectively and intelligently. And there's a real opportunity to be able to lower unit costs across everything that we do. And I think that's been the trend over the last decade, is we're able to do just the core back office processing at lower unit costs. And if we do it right, where we can figure out how to do it in a repeatable way, so that the more we do it, we can spread the costs over more transactions, then that that's really powerful for the industry and the value that can be provided to customers.
So technology is making things cheaper for your customers, and also making it cheaper for you. It's also changing how people expect to interact with businesses. So how, as a CEO, are you adapting to changing customer preferences?
Yeah, for sure. Well, the overarching trend has been people's willingness to engage with financial institutions digitally. And when this was first introduced, of course, it was more challenging because most of the capabilities that were introduced initially were available through a PC only. And over the last decade, we've made everything available through mobile apps, and the industry has gone that way. So you can do anything you want to do digitally, as well as through a live channel. And people had to get comfortable with that because it didn't feel natural at first. People are very careful about their money and how they think about making transactions when they want to make a transaction, and make sure that it's being handled right. And it felt odd to people, I think, at first, to be able to do things digitally. But of course, this pandemic environment that we're in right now has pushed that to just a whole different level of activity, where really, if you want to do so many things, you can only do them digitally, because people, of course, aren't interacting in person. So I think that's been, in the long run, a positive for the industry, that it's pushed a much higher level of adoption amongst our customer base. And that's kind of exciting. And we, and I'm sure many others in the industry, have been building our resources to be able to more nimbly introduce digital capabilities as fast as we can develop them, and as fast as new customer preferences can be detected. And so it's really interesting how this is all changing.
So people have speculated for years that it won't be long before we're opening IRAs via Amazon or Google, or that they'll be running 401k plans. Two-part question. What effect has Silicon Valley had on Wall Street in general, kind of an extension of what we've been talking about, but also how realistic is it that some of these, retail or other types of big powerhouses actually could get into the financial services business?
Yeah. Well, I like to remain prepared for anything. At the same time, I'm not sure I would hazard a guess as to what exactly other people are going to do. In the case of the companies that you mentioned, I would expect that they are looking at their opportunities and prioritizing what makes sense to them, and how attractive is an entry into financial services relative to an entry into lots of other businesses that they might be considering. So it's really hard to say. We've seen a lot of changes in the competitive landscape recently, in the first part of my career in this business, there wasn't so much of a huge change in the competitive landscape, but now the combination of the M&A activity and the fintech environment has just really changed a lot. And now the fintech movement has been underway for a while now. We were concerned about that before it heated up, so we were watching it carefully, and we knew that we were going to face some competition by well-funded startups in Silicon Valley. And we expected that many of those companies would lead with a customer experience and a digital customer experience. So we were watching carefully, and we were prepared for that. Now, we developed a motto at Fidelity that we asked everyone to adopt, which is scan, try, scale. And what we mean by that is we want everybody in the company to feel like innovation is part of their responsibility. And looking ahead in the industry and thinking about how we need to evolve and progress and even reinvent ourselves. This is not the domain of any particular strategic group or any innovation or singular R&D hub. It really is a responsibility of all Fidelity associates to think about where's the industry going and what are their ideas to progress and reinvent what we do already and what customers of the future are going to want.
So you mentioned fintech, and in the environment we're in, VC, venture capital money, is pretty abundant. Fintechs have not really been forced to prove profitability. They're understatement, perhaps, and they're mostly focused on the technology and the customer experience. As you noted, that's led to a lot of M&A activity. So is this a good thing, or should that innovation kind of come from within businesses, both Fidelity and just speaking more broadly in terms of, good corporate culture? Like where does the best innovation come from? Is it better to purchase it or develop it?
Yeah. Well, the fintechs, from our perspective, it feels a little mixed. It can be very frustrating to have competitors who seem to have bottomless pits of money and funding to draw on, but don't ever have to worry about profitability. And but at the same time, I think that the challenge of the high bar of the customer interface is actually a good competitive challenge for us. And these companies, they're taking their cues from the most advanced digital industries out there. So that's clearly where consumers' heads are. They're looking for their best digital experiences, whether it's coming from Amazon or Google or elsewhere, whoever their favorite digital experience is. That's the level of digital experience they're looking for every interaction. So the fintechs typically go on a very targeted basis, and we can learn from them. So we're watching and seeing what they're doing, and there's a lot to get from it. And sorry, there was another part to your question I didn't answer, but remind me what the rest of the question was.
That's fine. Just the notion of where innovation should come from, purchasing it or developing it, and whether or not that matters in the end.
So we have never been an acquisition-driven company. That's not to say that we've never done an acquisition. We've had some very small acquisitions that we have done, and we're very discerning in the acquisitions that we do. So generally, we are more of a build-oriented firm, and we know our customers, we know them well, and we have a corporate culture that we care deeply about, and all of our associates really embrace and appreciate being a part of. And it's important that we maintain that culture and nurture it. And that's not exactly congruent with or congruous with doing acquisitions where you take on a whole group of people who may have a different culture than your culture. So I wouldn't expect us to be terribly active on that front. And we are building a lot of our resources in terms of our people resources around being able to build things more quickly and to be able to frankly build more capabilities so that we can be more aggressive about getting into new offerings and new markets.
What do you think the asset management slash brokerage slash retirement plan provider landscape might look like in 5 or 10 years? Because as you noted, we've seen a tremendous amount of M&A, some of it really huge. Morgan Stanley buying E-Trade, Charles Schwab buying TD Ameritrade, Invesco buying lots of people and being rumored to buy lots of others. So are we looking like 10 years down the road where every company is kind of a full service firm like Fidelity is? And is that a good thing for individuals and corporate clients?
Yeah, I mean, hard to say. I'd say the trend around the big processing capabilities being more in the hands of a few big players is probably likely to continue because, I mean, if you think about something like processing trading volume, as you said, there is differentiation. I mean, trade execution is something that we believe that many people will continue to value, and that lots of brokerage customers who do a decent number of trading volume individually themselves on an annual basis will particularly be watching trade execution quality. But it's also a commodity service for people who are perhaps not as active. And you've seen now that the commissions have all but gone away, and so it's a very different business now than it used to be. And so that's kind of the extreme example. If you look at index funds, I mean, it's the same thing. I mean, the people don't really distinguish between the different index fund offerings. They're all so similar, and they're all extremely cheap, if not free. And so really the competition is based on service that gets offered around it, and what are the products that are differentiated. And so really that's where the competition will proliferate, is around the value added offerings of advice and more differentiated individual products that people value. So I would expect to see the new entrants and the more aggressive players in the market competing really hard in those spaces.
So I have a few more questions, and I definitely want to get to crypto. And I think some of our listeners want us to get to crypto also. But first, Robert, it was Ed L, was asking about other parts of Fidelity's businesses. It's been a long time since you guys were just a fund company or just a broker. What part of Fidelity do you think is maybe lesser known that you want to highlight, or a bigger driver of revenue than people may realize?
Yeah. So, I mean, we do a lot of business in the institutional brokerage space, and this is an area that's grown a lot for us over the last 10 or 15 years. We learned a lot about this space, both from our experience as a retail broker, but also our experience as a fund operator. So we've been able to really carve out a not very visible but an effective business trading securities for other institutions. So I would highlight that as a business where I think we've established a good reputation in a market that's not terribly visible. We've also been working to expand our offerings in the workplace world. And historically, we're particularly well known for being a 401k provider. But we have lots of other offerings that have been really well received by that community in recent years. And one area I would highlight would be the health area. I mean, for years, we have had an administrative offering around health and welfare for employers, but we didn't grow that for a long, long time. And now the changing landscape in that area has given us some new opportunities. We've been rapidly gaining share in the HSA marketplace, and we had that business for a while, but it was really small. We didn't excel at it. And that's changed just over the last few years. And we've got some product extensions to make HSAs easier for people to use and easier for employers to implement. So that's one area. Student debt administration. I mean, this has become a popular area for many highly talent-driven employers who want to be able to offer student loan debt forgiveness or better student loan management programs for people. And we've got a really nice offering in that area that has been well received in the marketplace. Also, our charitable platform for corporate charitable programs. It's small, but it's catching on. And I think particularly in this pandemic environment where corporates are looking more to provide a social conscience capability and functions around a social safety net for their associates to participate in, I would expect that offering to be well taken up as well.
Great. So we only have a couple minutes left, and Abby, you are clearly in everybody's minds associated with crypto, Bitcoin, blockchain. So I want to get to some of those questions. Robert P. and Elizabeth S. both had similar questions. For anyone who may not know, Fidelity was very early in working with Bitcoin. You began a Bitcoin mining operation in 2016, I believe. I think you actually allowed employees to experiment with it. Didn't your company cafeteria actually accept Bitcoin at one point? So tell us a little bit about what you learned and what your sense of where the next round of changes will be driven by cryptocurrency with regard to the investment industry.
So I would start off by saying, I mean, this is an industry, I mean, personally, I find it fascinating, but it's also become an area that's just, if you're like me and you have a day job, trying to keep up with it is really, really hard. So I feel like I'm not nearly as well informed about everything that's going on in the industry, which is just, super exciting. And right now, some of these distributed finance capabilities are really, this is an area that has been talked about from early on, but it's really starting to pick up. And, things like the Lightning Network that we're going to help facilitate that are actually starting to become reality. But at the same time, I think in terms of bringing the world along on digital currencies in general, what we're really, from a commercial perspective, putting our efforts around is trying to connect the legacy world with the future of digital currency. And so right now, our custody business around Bitcoin has been incredibly successful. We've got a tremendous pipeline, and it's been really exciting to watch And if you had asked me in the beginning if we or anybody was going to be prioritizing custody of Bitcoin, I would have said, no way. I mean, that's kind of the opposite of what it's all about. But the reality is that you do need it, because if you're an individual who engages an advisor and you want to make an estate plan, you actually need somebody to custody your Bitcoin, just as a simple example. So building those on and off ramps around facilitating trading between fiat currency and cryptocurrency is something that's happening now, and I'm glad it's moving along. And so you kind of have those two ends of the spectrum, the connecting to the legacy world and the really new advanced thinking that's going on. So it's pretty exciting. It's just become more than I can really feel like I can be an expert on anymore, but I'm really happy that I have a really vibrant community at Fidelity of people who are living and breathing and working on this full time. And we've got a lot of good momentum as a business, which is really exciting. And that's really what I sought to achieve when we moved into this. So I'm really happy about that.
Well, thanks. You've definitely done a terrific job continuing Fidelity's role as a pioneer in so many areas. Abby, thank you so much for a great discussion. I really appreciate you joining us.
Well, Beverly, it was great to be here, and thanks for having me.
You've probably heard of initial public offerings, or IPOs, but what about SPACs? These are special purpose acquisition companies, and they're a twist on a traditional IPO. SPACs are formed solely to raise money